This is the Asia Trade. I'm Haidi Stroud-Watts in Sydney. The top stories this hour. Asian futures are supported by gains on Wall Street, with treasuries advancing as traders price in 2 Fed cuts this year. But JPMorgan CEO Jamie Dimon is warning that a recession remains possible amid a tariff fallout. Coinbase says hackers bribed workers to steal customer data. They're said to have gained access to Coinbase's inner workings since January. And Alibaba's growth fails to impress amid a persistent Chinese consumer malaise that could impact the firm's AI pivot. And Nissan's head warns the firm must focus on itself first before considering a partnership with other companies. We've reached the end of the week here in Asia. Take a look at how we're setting up for this final trading session of the week. And so much of the narrative, of course, has continued to be dominated by what next when it comes to Trump's trade deals, the details of this détente with China, but also the implications when it comes to the Fed, given just the patchiness that we've had in US data and perhaps this hope now being revived that recession is no longer an inevitability. Of course, Jamie Dimon has shared his views on that. But take a look at the setup as we get into the trading session here in Asia in just about an hour's time. A little bit more positive when it comes to Sydney stocks that have been trading more or less sideways over the past few sessions. We're seeing potentially quite a pop at the open there. We had some surprising employment numbers that showed really the robustness of the labour market here in Australia and casting into doubt sort of any urgency for the RBA to move very quickly to ease. Chicago Nikkei futures looking pretty muted at the moment. Watching China very closely, of course, with the disappointment in those Alibaba numbers. Take a look at S&P futures looking pretty flat, along with tech stock futures there as well. Treasuries in focus as we continue to see this kind of readjustment of expectations in terms of what we're expecting from the Fed. And watching oil as well, continuing to see that decline after the 4-day rally as that potential for fresh Iranian supply now complicates that dynamic. Let's get some more now with our Bloomberg executive editor on Asia markets, Paul Dobson. So Paul, for you, what is sort of the strongest part of this complex narrative that we see at the moment?
Yeah, morning, Heidi. I think that the big thing that we saw overnight was that rally in the Treasuries market with yields down about 10 basis points right across the curve. That's in the wake of quite a stretch of selling that we've seen in the Treasuries market as well, that have been pushing up those long-term yields. We saw at the 30-year rate almost at 5%, the 10-year rate above 4.5% before yesterday's rally. And people looking at that US data, which not only showed sort of moderation in inflation expectations, but also slower demand in the retail sales. Now, everything comes with a proviso at the moment because it was April figures, and April is when the tariffs were introduced, came into effect, people getting worried about it, those kinds of things. So it's very hard to see, were retailers absorbing some of the increases in prices that they were encountering? Was it still that sort of inventory kind of hangover? But either way, the market seems to have taken it as a signal that maybe the economy is cooling a little bit. Maybe inflation expectations are a little bit overcooked at the moment. Maybe the Fed will lean more towards easing. And so that has brought down those yields again, which is probably a little bit of a relief for the market because it had been starting to get worried about higher interest rates, worried about higher inflation, worried about US spending and deficit as well. So that for me is the standout move from the overnight markets.
Yeah, so many kind of reasons as to why yields might have continued to push higher, right? The other part of the story is obviously China, and Tencent was sort of the good side of the tech earnings. Alibaba, not so much. What's your takeaway, particularly in terms of what it says about the consumer and what it says about these AI ambitions too?
Yeah, I think, like you were saying, Heidi, Alibaba sort of stands out a little bit more because JD.com and Tencent have been pretty good and had shown decent top-line figures, decent growth. So might be more something to do with the companies and the cutthroat competition that we see in that space rather than anything that you can particularly take away about the overall Chinese economy. But there were some troubling signs within the earnings, like you said, the sort of demand for cloud services, for example, not looking all that good. And we know that all of the all of the platform companies are really trying to get in to the AI stuff now, to the DeepSeek revolution in China, and which one of them is going to come out on top is going to be really interesting to see. For this set of results, at least, it looks like the competitors have managed to steal a little bit of a march on Alibaba.
And of course, whenever we see a Burry bet against or into something, we pay very close attention. Really interesting the way that he shifted his portfolio in that first quarter. Yeah. But it's a bit like what I was saying before. The first quarter was such a turbulent kind of time. We had the Trump inauguration. We knew what was coming with the tariff announcements, but we didn't know what they were going to look like. You'd be quite surprised if a lot of asset managers didn't go a long way towards cash. We heard similar things coming from even like big emerging market bulls, like Mark Mobius, kind of going all into cash. And so the idea that maybe Michael Burry had actually timed this pretty well, because in the first half of the first quarter, those Chinese tech names were doing well before we got towards that kind of like tariff angst. And then, of course, we've rebounded again. So whether he started to reload again at the bottom into this quarter, we don't really know yet. We'll have to wait again to see. But it could be that it was a well-timed moment to take profit and to sit on the sidelines and wait. Paul, how do you characterise the state of the market at the moment? We've got sort of some technicals showing that perhaps a rotation in the US market shows that we're entering kind of a more stable, healthy phase. But there is still quite a bit of fragility, right? If the temporary pauses on some of these tariffs run out, for example, if things kind of go south with China again.
Yeah, let's hope it's a little bit quieter, because it's been so wild recently. But I mean, it's hard to characterize things overall. We have had that really big rebound in equities all around the world, and particularly, kind of outside of the US as well, has been leading the charge there. And it's a little bit like the tariffs were never introduced in the first place, judging by where we are with the markets right now. Yes, there are little bits left over, higher gold prices, higher haven assets. And, I think that the next thing that is kind of like the nagging doubts that we have now are, one, the weakening dollar, which is starting to really play havoc with Asia's currency markets and pushing them higher. And two, we're starting to get more of those concerns about the US deficit, about this big tax bill that the Trump administration is working on, and whether that's going to see spending get out of control and the bond market is going to start to rebel against that again. So those are the two things to kind of watch. And if you have dollar down at the same time as higher yields, then that's a really troubling sign that people will be anxious about.
Bloomberg Executive Editor for Asian Markets, Paul Dobson there. Well, JPMorgan CEO Jamie Dimon warns that a recession remains a possibility as the fallout from President Trump's trade war continues. He spoke exclusively with Bloomberg's Francine Lacroix at the JPMorgan Annual Global Markets Conference in Paris.
We have all this uncertainty. Some preceded the new administration, like we had large deficits, interest rates going up, inflation going up, and some are, tariffs and things. And of course, the geopolitical situation is very tense, very difficult, and hard to resolve.
Okay, so if you forget projections, numbers, what's your hunch? Is the U.S. going to go into recession or not?
Look, I'm going to defer to economists who give it about a 50% chance. I think all these things are probably inflationary a little bit more and slowing down the economy. If there's a recession, I don't know how big it'll be or how long it'll last. Hopefully we'll avoid it, but I wouldn't take it off the table at this point.
If you look at, the trade war and then the somewhat reconciliation between the U.S. and China, does it hold?
I think it's the right thing to do is to back off of some of that stuff, to have an engaging conversation. I'm grateful they did the U.S.-UK deal. It's an agreement in principle, so, there's a lot of uncertainty still. And there's a lot of uncertainty still in the China thing, but at least we started. It obviously calms down the markets. That's not the reason to do it, but the markets, do vote and something like that. And so you'll still have uncertainty to resolve. There's 90-day triggers in a lot of these things, and hopefully they will be resolved. But they're complex. I don't expect immediate resolution, to the satisfaction of everybody in 90 days.
But do you expect markets to settle from here because we have a little bit more of a blueprint, or could volatility pick back up at any second?
Markets are quite unpredictable. I think there's a lot of uncertainty out there that you can't discount. War in Ukraine, terrorism in the Middle East, Iran, Huge deficits, our tax bill, which I would like to see a good tax bill pass. The tariffs, the reaction of countries to tariffs. The EU and the UK are about to negotiate. I think they have a chance to actually develop a great relationship, partially making up for, the disaster that Brexit became. And so, yeah, those are uncertainties. You can't eliminate them because you want to.
But what are your biggest clients saying about this market volatility? Have they made money on the back of it?
Yeah, some do and some don't. And, volatility could be good or bad depending on, who's facing it. So,
Has it been good?
But I would expect continued volatility. I think it's a mistake to think we can go through all the things we're going through and that volatility itself will calm down.
Has it been good for JPMorgan? What's your, trading revenue looking like?
Yes, because when there's volatility, this is a very simplistic way to look at it. Spreads gap out and traders make more money if there's more volume. So we had both this time, more volatility, more volume. But very often when you have a lot of volatility and spreads gap out, there's much less volume. So you've seen examples where there's good volatility and there's bad volatility. This one happened to be good. The next go around may not be so good.
JPMorgan CEO Jamie Dimon speaking there to Bloomberg's Francine Lacqua there in Paris. Well, the White House says President Trump has secured $200 billion in deals during his visit to the United Arab Emirates. The announcement came during the third and final leg of his trip to the Middle East. Our global economy correspondent Enda Karin is with us. And so, we continue to see a kind of really a roadshow of Trump wanting to show off his deal making and his approach to economic diplomacy. Some of these are focused on AI. Are there some concerns about aspects of the deals that are being made?
So, like you say, Haidi, it certainly was a big roadshow for the US president, trying to cement and lock in deals and relations across the Middle East region. One part of the deal-making has focused on allowing access or selling chips to some partners in the Middle East, for example, Saudi Arabia and the UAE. Now, those deals on chips come with guardrails. They're meant to be targeted towards, in some cases, US companies and the like. But our colleagues here at Bloomberg News are reporting that within the administration, there is some caution in terms of allowing some of this kind of technology to head overseas, even into the Middle East, because the concern is that technology would leak. And of course, remember, the whole backstory here has been this idea that the US wants to retain its lead in the global technology race. It wants certainly to curb its controls on chips flowing into China. And the concern that our colleagues have noted out is that some officials in the administration are worried that this might be overstepping the market a bit. And it also, of course, speaks to the idea that within the administration, there are clearly, if you want to call it the hawkish side, who are, focused on national security, willing to drive pretty tough trade deals and the like. And of course, you might have the more pro-investment, pro-market side, who are willing to do kind of more sort of transactional deals. So clearly some difference of opinions within the administration in terms of who they can sell chips to and who they can allow that technology to fall into the hands of.
What were some of the other major takeaways for you when it comes to this trip?
I think the big headline number out of it was this idea that President Trump has secured over $1 trillion worth of economic commitments. Some of those are in the form of corporate contracts, for example, big purchases of Boeing planes and big purchases of US weapons and the like. So there's these commercial contracts. There'll be plenty of skepticism over around how much of these are new announcements, how much of them will be seen through to the end, what's an MOU, what's an actual deal. So, the White House claiming a win. Skeptics say they'll want to see more details on that. But it was also, of course, there was more in this trip. There was the lifting of sanctions on Syria, which was met with that rapturous applause during his speech in Saudi the other day. There was a meeting with the Syrian president. So, it was President Trump's first major trip overseas. He clearly chose a very sensitive and geopolitically important part of the world, and he put his flag on in terms of A, signing deals, and B, promising kind of a new approach to that region, a new kind of a non-lecturing tone, I think, was more or less the message of his speech to that part of the world. So certainly President Trump's first big step onto the global stage, and of course one driven by, on the one hand, deals, and on the other hand, of course, geopolitics and putting the US, trying to shape a new US narrative around how his administration will approach those challenges.
It's a really interesting state of the economy for the US at the moment, right? Because on the one hand, there seems to be some comfort that perhaps a recession can be avoided, particularly if these tariffs are sort of weaned off. On the other hand, there's clearly ebbing of economic activity. This all feeding through with these changing Fed expectations.
Yeah, it's interesting, Heidi. I mean, when the president was away, this is the first week we've had since, the big turnaround on the China tariffs at the weekend. Obviously, sentiment in financial markets are much better. We're getting some economic data this week. Again, the economic data telling mixed story, but today we had numbers saying that retail sales actually starting to show signs of a slowdown there, with industrial production, industrial output falling for the first time in 6 months. So there are some warning signs emerging. Big retailers as well, I should also add, saying that, look, eventually they're going to have to pass on some of these costs. But that said, we still haven't had a clean read on data yet in terms of how these tariffs are impacting either activity or prices. It's probably going to take a while before we do start to get a clean read on that, given the announcements, the stopping, the starting, the pausing of these various tariffs on different products, on different sectors, on different countries, at different levels. It's going to be hard to note out. But to your point right here, right now, there's a view that maybe a recession risk has been pushed down the worry list a little bit, but certainly lots of concern about where this is all going. Average tariff rates remain high by historical standards. Tariffs on China, depending how you slice and dice it, somewhere in the 40s, which of course is still very high by historical standards and quite high for those small businesses who rely on imported components or finished products from China. So we're not getting a good read from the data right now. It's going to take a little while longer, I think, to just note out exactly how the trade war is impacting the economy.
Bloomberg Global Economy correspondent Enda Karin there with the latest. And Chinese Vice Commerce Minister Li Chenggang says he had good talks with the U.S. Trade Representative Jamison Greer at the APEC meeting in South Korea. The two met less than a week after the U.S. and China agreed on a temporary pause in tariffs.
Minister Li, how did the talk go with Greer?
Good talks.
What topics did you discuss?
Topics on trade?
Are you going to talk with him tomorrow?
Probably not.
When's the next talk with Greer?
I don't know yet.
Will President Trump and Xi have a meeting?
I don't have any information.
How about a phone call?
I don't have any information.
More ahead on the Asia trade. This is Bloomberg. Let's dig into one of our most read stories today. Shares of US crypto exchange Coinbase tumbled after it disclosed a hack that put customer data, including banking information, at risk. And according to reports, the company is also under investigation by the SEC for misstating user numbers. Our reporter Annabelle Jewellers joins us now from Taipei with more. So it's certainly not the most we've seen taken when it comes to a crypto heist, but it does stand out for a number of other reasons.
Yeah, that's right, Heidi. I mean, when you think about just sort of the numerical value of this, I think it's supposed to cost, or the report says it's going to be costing around $400 million. So that would be the 8th most consequential that we've seen. But you think about the significance of Coinbase to the crypto industry, and this is really where it comes to the fore here, because this is the company that has pretty much single-handedly or been at the forefront of bringing crypto assets into the mainstream of finance. It's the company as well that safeguards most of the tokens that are owned by the spot crypto exchange ETFs in the US. And it also has been the firm that's been most prominent when it comes to lobbying for more business-friendly rules in Washington. So this is really what speaks to the significance of this, not just the timing as well, because Coinbase has only just been added to the S&P 500 index. So yes, $400 million is the cost of this. The company as well, Coinbase, saying in a statement that the hackers have demanded a $20 million ransom. They're not going to be paying that. Instead, they're saying they're going to use those funds to work toward finding out information to try and lead to the arrest of these criminals.
How exactly, that we know of, did the hackers pull this off?
It's not exactly technologically savvy, actually. I mean, it's brazen, but it's not the most sophisticated hack we've seen. What we're understanding about it is that these hackers actually worked with some of the consumer representatives or customer representatives in India. They bribed those customer reps to then access personal information of Coinbase users. So you're talking about things like a date of birth, addresses, bank accounts, government IDs, when the customer accounts are being created, the amount that's in those customer accounts as well. And then what these hackers did was use that data to then impersonate Coinbase to then approach customers and allow them or give the hackers access to these customers' accounts as well. And so the issue here is that it's not just a huge invasion of privacy from some of these users or for some of these users. There's actually a safety aspect that comes into play as well, particularly in the crypto industry, because we've seen at least one kidnapping, actually a kidnapping that led to a mutilation earlier this year, but there have been reports of other kidnappings as well. So some of the most high profile, the most involved people in this industry could certainly be feeling very vulnerable off the back of this.
Briefly, we're also hearing about reports of an SEC investigation here.
Yeah, that's right. So this one actually is reporting that's come through from the New York Times, but they're looking into whether Coinbase misstated some of its user metrics. This would have been part of past disclosures, and something that the New York Times rather is saying actually began as an investigation during the Biden administration. We did actually get a response from Coinbase, the legal rep or the chief legal officer rather there, responding to that New York Times report, but saying that or calling it a holdover investigation actually, and something that they believe should be dropped, and something that they're saying as well they stopped actually reporting those user metrics more than 2.5 years ago.
Annabelle Jewellers there in Taipei. More ahead on the Asia trade. This is Bloomberg. This is the Asia trade. Some of the corporate headlines that we're tracking this hour. Meta shares dropped after a report that the company was delaying the rollout of its flagship AI model. The Wall Street Journal reporting that Meta engineers are having trouble improving the capabilities of the large language model known as Behemoth. The paper says Behemoth's release has now been postponed to fall or later. President Trump says the Indian government has made an offer to drop all tariffs on U.S. goods. He gave no further details on this while speaking at a business event in Qatar. India's trade minister is expected to meet the Trump administration's officials in the U.S. this weekend for negotiations. Meanwhile, the president also says he's asking Apple to stop moving its production for iPhones to India.
I had a little problem with Tim Cook yesterday. I said to him, Tim, you're my friend. I've treated you very good. You're coming in with $500 billion, but now I hear you're building all over India. I don't want you building in India. You can build in India if you want to take care of India. We want you to build here, and they're going to be upping their production in the United States, Apple. So Apple's already in for $500 billion, but they're going to be upping their production.
Shares of Applied Materials fell sharply in extended trading after the company gave a lackluster forecast. The largest American maker of chip manufacturing equipment expects sales of about $7.2 billion for the current period, which is lower than some analyst estimates. The company is adjusting to restrictions on sales to China, which is one of its biggest markets. More ahead on the Asia trade. This is Bloomberg. Well, for many investors, treasuries and the dollar were the tried and tested safety bets during a market crisis. But lately, those playbooks are being quietly rewritten as US exceptionalism is no longer being a given. Bloomberg Originals looks at how the days when the country could count on its economic advantage are seemingly at an end.
When it comes to investments, there's no such thing as guaranteed returns. But the U.S. has, for years, been viewed as an exception.
The U.S. sits in a very special place in the global economy.
American exceptionalism is a concept that has been gaining traction because the only place where you could find growth was the United States.
Global investors have known that American markets are about as close to a sure thing as they can get.
It's rooted in the concept that America has some sort of special sauce, that it's different in some capacity. But all of that is going away.
You've ripped us off left and right, but now it's our turn to do the ripping. America first!
We are getting to a period of more protectionism and more difficulty to trade abroad.
Trump announced these sweeping tariffs. We immediately saw a pretty stark reaction.
Tariffs rattle markets with a sweeping sell-off.
Is it the end of U.S. exceptionalism?
The simultaneous decline in the equity market, in the bond market, and in the U.S. dollar. All three of those together tell you that there's that sense of disquiet.
So what happens when the world's favorite money-making bet is no longer a sure thing?
Subscribers can watch that Bloomberg Originals documentary in full right now. It's on the terminal and at Bloomberg.com. It'll also be up on the YouTube channel a little bit later. Well, Alibaba's latest quarterly revenue grew a disappointing 7%, reflecting a persistent Chinese consumer malaise that may dog the company's big pivot towards AI. Let's get more perspective now on some of these Chinese tech earnings with Karin Kong, who's the Tianfeng Global Research Institution head at Tianfeng Securities. Karin, great to have you with us. Were you surprised by the weakness that we saw coming through from Alibaba, given the robust numbers that we had Tencent that clearly reflected a different trend for those consumers?
Okay, thank you for having me here. Good morning, everyone. And I think we have to break down the numbers. If we look at the e-commerce, the core e-commerce for the Taotian, we can see year-on-year growth of 9%. And if we look at the modernization of CMR for the core e-commerce business, it's a 12% strong bid. It's a strong bid to the market anticipation of 8%. So I think a little bit for the market have a high anticipation for Ali. And if we look at the AI sector, I think the AI sector, the cloud business acceleration from this quarter is 80% year-on-year growth. And I are still confident about their AI cloud business grows steadily from this quarter. And if we think about the DeepSeek movement, it have a positive impact. I think the mainly start from the second quarter of this year. So I think we should combine to look up and break down the numbers.
So the market expectations, you say, are too high. What about going forward? Does this very much depend on how much more stimulus we get from the government, how things progress in the US? Do you think those macro factors will feed into how that Baba consumer improves?
Yeah, I think the one thing is we were confident about a lot of room for stimulus and stabilize for the Chinese economy, and also we can to look up for the fundamental thing, not only from the e-commerce, because I just mentioned before. I think the core business, core e-commerce business for Ali is impressive for many of the investors, especially for the modernization for the core business, e-commerce business for Ali. So if we look at the future, I think they will gradually and steadily grow for the e-commerce core business sector, and also for the AI cloud business. Just like I mentioned before, I think they will gradually and steadily grow. And management mentioned that the AI-driven revenue related to the demand is a triple-digit growth for AI products. And the management that just mentioned several days before, they were integrate AI into every sector of Alibaba, for 3 or 5 years. They plan for the long term. And if we look at the AI, the AI strategy for Ali, we can see they have the leading model for Tianfeng. It's a really competitive model. And also if we look at for the Ali, they have a AI application ecosystem. That is very competitive. And also the AI cloud business is very competitive and leading in China and globally. And if we compare the P ratio, it's like 12 P ratio compared to like the U.S. market, the U.S. tech giant is more than like 20. So I think there's if we compare the Ali to other big giant tech giant, I think that their P ratio is low. It's quite cheap. And with the AI, we are still in the context of the AI story for Ali, and the steady growth for the core e-commerce growth. I still confident for them.
That investor enthusiasm when it comes to the AI cloud part of the business, is that more based on sentiment than actual profitability? Because the competition within that space is pretty intense.
Yeah, sure. There is a lot of there are several like player in the AI core business. But if we compare the Ali AI cloud business, we can see they are still leading in this field in China, and also I think there's like it's also leading in the world, like the fourth place in the world. So. Although there are several like AI cloud player, but I talk to a lot of like the consumer, their AI like cloud consumer, there will like pick Ali in China for their cloud, for their they have a very competitive model, and they have a better like AI application system and better like AI products.
Karin Kong, who's a Tianfeng Global Research Institution head at Tianfeng Securities. And subscribers can watch us live and see our past interviews on our interactive TV function. That's at TV Go. You can also dive into any of the securities or the Bloomberg functions we talk about. And join in on the conversation as well. You can send us instant messages. To check it out, it is at TV Go. Well, Nissan CEO Ivan Espinosa says the carmaker must get its own house in order before considering partnerships with other companies. Nissan announced it is closing factories and cutting 20,000 jobs in a bid to stem mounting losses as it posted its worst financial results in 25 years. He spoke with Bloomberg's Shery about whether those measures are enough.
We're confident that this is enough because the plan, as I said, is robust. It has a leg on the fixed costs, which is what you were talking about, restructuring our manufacturing footprint and work around our overall size in terms of human resource. But not only, it has another very strong leg on the variable cost front. Yeah, on the variable cost front, we also have around 250 billion yen of costs that we will reduce. And we are already working on this. We started a few weeks ago with a team of around 300 experts. And in the few weeks that they started to work, we already have visibility to around 75 billion yen of savings in variable costs. Yeah, and we're accelerating this by putting additional 3,000 dedicated people into this sprint on the variable cost front that will drive a lot of savings. Yeah.
Given the uncertainty and the lack of visibility when it comes to tariffs, of course, how will that impact the overall restructuring effort?
Yeah, well, the manufacturing footprint, the design that we put around is very flexible. So one of the beauties of Nissan is that we are a global company that has a very broad footprint in terms of operations. And taking this into account, the plan that we have laid down has this flexibility to adjust.
As you said earlier, the issues are pretty fundamental, right? I mean, given that even without the tariff risks, already Nissan was struggling. How do you turn that around? Even when some people are saying, is Nissan trying to cost cut its way out of finding new innovative models, new products that can appeal to global consumers?
Yeah, but we're not doing that. What we're doing is resetting the size of a company. Even, you know, what we announced was for FY25, if you remove tariffs, the visibility that we have for that company was to be break even already. So the trend and the trajectory has changed. Tariffs, of course, are a burden in FY25. We have sized the total impact in the year, which is around 450 billion yen. But already for Q1, our visibility is to mitigate around 30% of that. Yeah, and we have teams actively working on mitigating even more. So we think that we will be, I'm not sure if we will close the whole gap, but we will be much better than what we have announced in terms of overall tariff impact.
When it comes to the manufacturing footprint, Nissan actually shifted manufacturing of some popular SUVs from the US to Japan in the past decade. Given the tariff uncertainty, could you even consider shifting them back?
Now, actually, today, this is a very, very good position that we have. The fact that, for example, our Nissan Rogue today is produced both in the US, in our Smyrna plant, and also here in Japan, in our Kyushu plant. And this gives us this flexibility that I was referring about earlier. We can pivot and change the mix of production depending on the Forex exchange. If the tariffs in some of the trims are hitting us harder because of the supply chain and how the vehicle is composed, we have this flexibility to shift the production, and it's something that is helping us a lot today to deal with the tariffs.
When it comes to car parts, how exposed is Nissan? How exposed is Nissan when it comes to car parts and potential tariff risk?
Yeah, well, as every manufacturer, we are exposed. But the good thing is we have a lot of vehicle lines that are produced in the US, and we are working very closely with our suppliers to accelerate more resourcing of parts. But again, I come back to the point of needing clarity, because it's very difficult to invest or to make decisions on investment without clarity on what the rules may be. They're changing every other week, so it's a bit complicated for us.
And you've talked about really these partnerships globally, right? Whether it's in the form of capital discussions or projects. Are full-blown mergers on the table still?
Yeah, well, today we are focusing on our plan, on bringing Nissan back to where it needs to be in terms of sustainability.
But in order to get there, you need help.
Not necessarily. You know, we have very ample liquidity today. We have 2.2 trillion yen in the bank, cash, net cash today. Yeah, plus uncommitted credit lines for another much more. Yeah, we get total liquidity can run up to 3.5 trillion. So we have a solid footing in terms of liquidity today. Now, this doesn't mean we don't need to move and protect free cash flow and protect capex and make some smart choices. But I don't want to become a hostage of our current situation in order to make a decision on partnerships.
When it comes to the capital structure of Nissan right now, and you mentioned how liquidity is still solid, what about investments coming from the likes of Honhai, which have been floated?
Yeah, well, we're open. And as I said, at the moment, we don't need capital investment. We have enough capital in the bank, and we are focusing on building the right footing for the company. So we're focusing 100% on the deployment of the plan, a plan that is credible, that is robust. We have the right people, we have the right content in the plan, we have the right product to support us as well.
Your liabilities will rise to over $5.5 billion by next year. So despite right now where you stand in terms of the capital position of Nissan, you're not necessarily looking at a full-blown merger at this point.
Yeah, we're considering, as I said, the strategy today is to focus on the short-term improvement of the company. Again, the point is not to do a partnership because we need to be partnered with somebody because of the cash position. The cash that we have on hand is enough to go for the next 12, 18 months without doing anything.
So do you have a view, if you have a future partnership, of what type of company it should be, a car maker, tech company?
As I said, we are looking at different partners. We have traditional OEMs, we have technology companies, and we have also some China. You know, China companies are also very interesting. So we're looking at everything today, but there's nothing concrete I can tell you about that today.
When it comes to sales inside China, for example, your forecast in your latest earnings call was for a fall of 18% or so. Does that mean that you will have to adjust operations, shut down factories if need be?
Yeah, what we're doing today, we have adjusted operationally the capacity in China to run at around 1 million. And we don't see the necessity at the moment to cut more. We are, as announced in the Shanghai Auto Show, we're investing in new cars. That, again, as mentioned before, they are going to be focused in China, but the additional leg of this plan is to have exporting these models outside of China. With that, we balance the risk of a very competitive Chinese market, and we bring the strengths that we have today in terms of cost, in terms of speed and innovation and technology outside of China to some selected markets.
What's the time frame of exporting?
As soon as we can.
Oh, within the year?
Yeah, we will do that very quickly.
Shery on there speaking with Nissan CEO Ivan Espinosa. More ahead on the Asia trade. This is Bloomberg. Watching the yen as we wait for those GDP numbers that are expected to show a contraction in the first 3 months of the year for the Japanese economy. We are set for a fourth day of gains when it comes to the yen trading against the dollar. This is the longest streak in about 3 months ahead of that data. That dollar-yen pair set to see its fourth week of gains, the longest since December 27th. We're also seeing Japanese bonds pointing to a rise in cash trading following on the back of the rise that we saw in US Treasuries. Yields there dropping with that softer than expected US inflation data there. We're also seeing some lines coming through when it comes to the Japanese finance minister, Katsunobu Kato. They're speaking in Tokyo, saying that he's confirmed with US Treasury Secretary Scott Bessent that excessive FX moves harm the economy, confirming that there should be some sort of agreement when it comes to the discussions on FX as well. We are getting the GDP numbers out now. The first quarter GDP on an annualised basis seeing a contraction of 0.7%. That is steeper than expectations of 0.3%. That deflator coming at 3.3%. If you break it down for the annualized seasonally adjusted number, a contraction of 0.7%, a nominal seasonally adjusted quarter-on-quarter, a gain of 0.8%. That seasonally adjusted headline quarter-on-quarter number, a contraction of 0.2%. So really roundly missing expectations there. If you break down by private consumption, we saw no growth. Expectations were for marginal growth there. Business spending quarter-on-quarter actually coming in a bit stronger than expectations. 1.4% expectations had been for just growth of over 0.5% as well. The net exports contribution to total GDP is an interesting one. For the first quarter, the preliminary reading seeing a fall of 0.8%. That was also worse than expected. And of course, all of this coming through at a time when expectations of a trade deal or a détente between Japan and the US is still very much in the works there. So we are seeing a bit of a mixed picture, but certainly that imports number is quite interesting for Japan. Well, Google says it remains committed to its AI development efforts, even as rising trade tensions affect the tech industry. Its Global Public Policy Vice President, Karan Bhatia, tells Bloomberg that he sees the new technology leading growth in Asia.
Look, we're very bullish about AI and what it's going to offer for the region. We think that we're already seeing incredible adoption of the technology. The positive public sentiment, when you look at polls of different countries around the world, it's this region, the APEC region, that's most optimistic about artificial intelligence. So we're seeing great momentum behind that. Sure, there is always geopolitical tensions. There are always, ups and downs. We love stability, but we're in it for the long haul, and this region we continue to see growing over the long haul, and AI is going to be a particular spur to that growth.
Yeah. What does the bifurcation of the development of AI and also, of course, the rise of Chinese domestic innovations in AI, lower cost ones as well as open source, like DeepSeek and a number of others coming out of eastern coastal China in Zhejiang province in particular, how does that change the landscape for a company like Google? And you have multiple AI initiatives.
Sure. Look, certainly cognizant of the investment that China is making in AI, and you got to look at something like DeepSeek and be impressed by the innovation that's created there. But having said that, I think we feel very confident about the strength of our investments. We've been in AI for many years, probably before anybody else. We've had a terrific success with our Gemini model, which is now performing at top of the tables and is also really helping, I think, businesses and governments in this region address some of the key pressing challenges, whether it's health, whether it's energy, whether it's agricultural productivity. We think AI, in partnership with Gemini and with Google's tools and platforms, is really going to be a game changer.
How do you see the trade disruptions and the uncertainty in the corporate boardrooms, how to navigate through this uncertain times, even with the 90-day truce between China and the United States? Oftentimes, spending patterns on advertising, and so much of your revenue comes from advertising globally. I think about half your revenue comes from the international market as well. How do you see this potentially being an unintended consequence of a global trade war, and that is decreased spending, decreased revenue for a company like Google?
Yeah, look, as I mentioned before, Stephen, we are really in this for the long haul. When you're making the kinds of investments that we're making in R&D, in CapEx, and we've, announced that we're going to be spending $75 billion in capital expenditures this year, a number that we reaffirmed recently. Those are long-term investments, right? So we're going to see bumps in the road. We're going to see geopolitical, macroeconomic, other changes. But the reality is we remain pretty committed to ongoing growth.
Google Vice President of Global Public Policy, Karin Kong, they're speaking with our Chief North Asia correspondent, Stephen Engel, at the APEC Trade Ministers meeting in Jeju. Take a look at how we're setting up. We're just about 5 minutes away from the start of cash trading here in Sydney. Also, Japan coming online with the GDP numbers, with the first quarter GDP falling an annualised 0.7% quarter on quarter. Some weakness there in net export contributions there as well. But we are seeing those gains when it comes to the Japanese yen. We're also seeing JGBs expected to continue to follow the gains that we saw in US Treasuries overnight. Sydney futures, we could see a bit of a pop there at the open, currently trading high by 0.9%. We're also seeing just sort of treading water when it comes to S&P futures at the moment, as these recalibrations of Fed expectations. It's now 2 cuts by the end of the year, given that inflation data that we've had this week. But the trade truce rally continues to hold, albeit with a little less volatility at this point. We do have the market opens in Sydney, Seoul and Tokyo next. This is Bloomberg.
This is Asia Trade. We're counting down to Asia's major market opens, and we could see some upside coming from gains on Wall Street. Haidi, we had stocks rising, treasuries rising, markets now pricing in 2 Fed rate cuts. We had some economic data surprising to the downside.
Yeah, and downside when it comes to Japan eco data as well, right? We see this sort of pressure on the economy in the first quarter, even before the jolt that might be expected from US tariffs.
Yeah, so not surprising really that the Bank of Japan pushed back sort of expectations for the next rate hike. We have seen the Japanese yen now strengthen for 4 consecutive sessions, though overnight we saw some strength against the US dollar. Take a look at how we're opening in this session, because we had seen Japanese stocks lose ground for the past 2 sessions, and we are now seeing the open. And right now, markets seeing not much change when it comes to Japanese yen. A little bit of upside when it comes to the topics early in the session. Of course, we're heavy into earnings season as well here in Japan. We're watching the 10-year yield at that 146 level. Treasuries, of course, as I mentioned, gained overnight. We had some disappointing eco data, including factory prices and retail sales as well. Take a look at how the Kospi is coming online. We saw it lose ground in the previous session. Of course, trade negotiations still a top of mind. The Kospi gaining 0.4% early in the session. The Korean won holding steady at the 1396 level, really strengthening a little bit early in the session. We had seen some downside pressure, Heidi, from reports by Bloomberg that the FX issue was going to be not necessarily discussed during the upcoming trade negotiations.
Take a look, Shery, at how we're setting up when it comes to the session here in Australia. Seeing a little bit of early gains there as the cash session staggered, of course, gets underway here in Sydney. We're up about 0.2% there. The Aussie dollar is pretty much sideways, despite, of course, some of the gains that we've seen in other Asian currencies with the softness overnight in the US dollar. We did hear from Warwick McKibben, who's a former RBA board member, saying that the Reserve Bank should keep rates unchanged next week due to the very large fiscal stimulus and elements of elevated global uncertainty. So it contrasts really with the consensus view of a rate cut next week. So it'll be very interesting as we watch that going forward. Also watching oil markets as well, as you see that sustained downside now kind of being encouraged by this shifting of expectations when it comes to Iranian supplies potentially coming back on. Let's bring in now for some analysis Kyle Rodda, who's a senior market analyst at capital.com. And Kyle, it has been a while since we've had some level of sort of calm trade in these markets. You think there are a few caveats, though, as to whether this can continue?
Well, it all depends on trade negotiations and trade deals being done, and effectively those trade pauses or pauses on tariffs effectively being lifted. I mean, markets are pricing that in effectively, that this is going to be something that is very soon a thing of the past. Obviously, there is some mystery around to what extent this has done damage to the real economy. But for the most part, markets are pricing in a fairly short and shallow slowdown, especially for US growth, but global economic activity as well. And that investors are more or less buying into the fact that, at the margins, the economy will be in a better position going forward. And, other things too are also supporting that now. Weaker inflation data in hopes that the Fed will be able to cut interest rates. And in the background as well, the prospect of fiscal stimulus coming through from, from US Congress as well. So, I mean, there are a lot of what-ifs still on the table. Again, it's all about those deals being done. But the statement of intent from the Trump administration seems to be there that they want to achieve that. So the market's now pricing in a much better outlook. And again, a rather unnecessary shock to the economy, but one that's going to be relatively short and shallow.
Where do you see the opportunities then, particularly if we kind of see more of a structural upside for the US dollar? Are there FX trades that you're preferring at this point?
Yeah, I mean, I think in the longer run, and if you want to tell the structural story, I think the US dollar is going to continue to see some downside, really on the basis that there is going to be a permanent credibility hit to the United States and US assets, which was really only compounding something that was already going on in terms of de-dollarization and trying, obviously surplus countries moving reserves away from the US dollar and treasuries in particular and to things like gold. Gold, for example, remains a good long-term play from a structural perspective as well. But if you throw in the cyclical elements there, and going back to almost to our first discussion point there, which is to say that the markets haven't really fully priced out the impacts of trade uncertainty just yet. Indeed, there are still potential tipping points that we may see the economy reach because of the impacts of the uncertainty and the prospect that maybe we'll get some sort of second-order effects coming through on real economic activity that could potentially put sort of a dampener on things. But if we continue to effectively see the markets moving in the right direction, or I should say trade policy moving in the right direction, the dollar has been a little bit oversold recently. That needs to revert a little bit. There has been some restoration of credibility into US assets, so the dollar has to appreciate a little bit on that basis as well. So those cyclical plays are really, really quite positive for the US dollar. Structural perspective, again, things like gold still looks good. Things like the dollar looks a little bit weak. The Japanese yen also a case to buy into that as well. But I don't think we've seen the full pricing out of trade war risks. And provided that Trump continues to give the markets what they want, which is a pro-market Trump, then further reversion in the US dollar, especially as rate cuts get priced out of the market, looks like a pretty good play to me.
On top of all of those macroeconomic uncertainties for oil, for example, you also have to factor in the potential Iran-US deal, according to President Trump. How do you play energy assets?
I think we're seeing a double whammy when it comes to oil markets at the moment. There's the demand side of the equation, the fact that OPEC has pretty much stepped away from the break, so to speak, when it comes to supply. And then now we've got these developments that potentially we could get an Iranian nuclear deal. Of course, if you do listen to the rhetoric coming out from the Islamic Republic over the last couple of days, it's not exactly been cordial. Perhaps even a little bit hostile towards the US still. But nevertheless, there are whispers, especially now that the Trump administration has started this charm offensive through the Middle East and normalised relations with Qatar, that Iran is effectively going to be forced to the table. If that happens to be the case, then you get that sort of extra hit on the supply side to an existing, OPEC dynamic, which seems to be very, very loose with supply relative to, the recent history. That means that everything is going to be sort of skewed towards the demand side of the discussion and marginal changes in the demand outlook to really drive prices higher from here. Although we're likely to see that, there'll be an improvement to the economic outlook, at least compared to, say, 4 weeks ago, when there was, major concerns about global recession, and the tariffs on China was looking at potentially crippling industrial demand over there. If you compare it to, say, the start of the year, well, the economic outlook is still a little bit weaker and still likely to be sort of diminished going out into the medium term as well. So oil looks like it's going to continue to retrace lower. Those lows at around sort of 55, 56 on the West Texas Intermediate contract is going to be very significant from a technical basis. And again, because the supply side is looking much looser, the real marginal driver is going to be demand. And while demand is going to, again, improve in the short term, just because of the stepping back of trade war risks, in the bigger picture, it's still probably not going to be strong enough to pick up that supply glut.
Kyle, we also heard that Michael Burry is now betting against Nvidia. And of course, he successfully bet against the housing market in the U.S. back in 2008. Is this a good time to be selling these really huge tech names that have rallied so much?
Well, this comes down to me as to a question of valuations and where we are compared to the start of the year. And if you look at, say, the Mag 7 stocks, and really we'll call it Mag 6 because I'd say Tesla's probably unfairly or unnecessarily sort of plonked in with those other sort of more artificial intelligence names, is that they're nowhere near as expensive as they were at the start of the year. Positioning is nowhere near as stretched. And we're seeing deals being done between the US and China, which sort of removing some of the risks to chip demand going forward. Of course, there's going to still be some sanctions there in terms of what chips China can buy, but it would seem that Nvidia is being fairly responsive to that and providing, obviously a new product to the Chinese market. And overall, we're seeing still these signals that the demand for chips remains reasonably robust. The artificial intelligence trade remains, very much in play as well. And again, valuations are more attractive than they were before. I mean, the wonderful thing would have been to be able to pick up Nvidia at sort of $86 or $87 per share when got that extreme buying opportunity a few weeks ago. But if you look at kind of the tech landscape, their earnings, the narrative behind it, especially now that Trump's, the old Trump 1.0, where he targets the stock market, I don't know why you'd necessarily be betting against these artificial intelligence names unless we get another significant shock like we did a few months ago.
Kyle, what are your expectations when it comes to the RBA? We just heard from Warren McKibben saying that they should refrain. There's plenty of voices suggesting that, we should see a protective cut next week.
I think the RBA has signalled their reaction function, although less clearly than other central banks, which is to say that they want to move preemptively to protect, obviously, households and the broader economy from global risks. And they've also said that they're happy to lower interest rates as inflation moves towards target, or the mid part of their target band, rather than once it gets there as well. There's a very strong argument that it shouldn't cut interest rates, really on the basis that it's hit its employment mandate, and it has done for the last few years. We're notionally above levels of full employment, according to the RBA, and we've only just slipped back into the 2 to 3% target band for the first time in 4 years on a trim mean basis. So really, they haven't, at least based on a very purist point of view, done their job properly just yet. But if you look at the summary of the SOMP, the last SOMP that we got in February, effectively the RBA forecast that inflation would end the June quarter at 2.7%. It cut interest rates in February when inflation was above the target band on the basis that it was forecasting prices to get back to that level. We still remain on that trajectory. Market pricing is suggesting a 96% move of a cut, and there's been no pushback in the last few weeks against that. So it's going to be very difficult for the RBA to cut. It's going to be very difficult for the RBA to argue against a cut. So I think it will cut, but it's going to be a very contentious cut, really, on the basis that, again, from a purist point of view, they've only just achieved their job, and barely so.
Kyle Rodda, Senior Market Analyst at Capital.com. Thank you so much for joining us. We do have some breaking news at the moment. CATL, now, of course, a Chinese electric vehicle battery maker, we're getting the terms of the deal pricing $4.6 billion Hong Kong listing at 263 Hong Kong dollars per share. So it's fully upsized now to $4.6 billion. It was, of course, a long road to finally reaching its destination listing in Hong Kong, but we're finally getting the terms of that deal, and we're hearing that it's been at 263 Hong Kong dollars per share for a listing of $4.6 billion. We have more ahead. This is Bloomberg. Chinese Vice Commerce Minister Li Qiangang told Bloomberg he had good talks with U.S. Trade Representative Jameson Greer at the APEC meeting in South Korea. The two met less than a week after the U.S. and China agreed on a temporary pause in tariffs.
Minister Li, how did the talk go with Greer?
Good talks.
What topics did you discuss?
Topics on trade?
Are you going to talk with him tomorrow?
Probably not.
When's the next talk with Greer?
I don't know yet.
Will President Trump and Xi have a meeting?
I don't have any information.
How about a phone call?
I don't have any information.
The WTO Director General says any decoupling of the US and China would create negative spillover that could hit the poorest countries the hardest. Ngozi Okonjo-Iweala spoke with us from the sidelines of the APEC meeting in South Korea about the mood among delegates.
I would say that the tone has been very constructive. I mean, everybody is obviously quite worried about the global trade environment, and that's understandable, but very constructive tone, a willingness to look at what should we do and what are the solutions.
What is the feeling from your standpoint, too, about the truce that was sort of struck in Geneva over the weekend, where we basically knocked 115% down on tariffs for the U.S. and China? That sets a better tone. Are you encouraged or still concerned about global growth going forward and global trade?
I'm very encouraged, to be honest, because we had felt that any decoupling of China-US or breakdown in their trading relationship would have quite negative spillovers on the rest of the world, but especially on poor countries, especially if trade really fragments into two trading blocs. So the fact that there's been a de-escalation, an agreement to reduce tariffs to the extent they have, I think is a good sign. We've actually started to model what the 30% for China and the 10% for the US that China has put in would mean. And it's really helpful that it shows, instead of a 0.2% contraction of global trade, when we layer that in, it turns around to a 0.1% growth. You know, so it's a turnaround, not as large as we would wish, but it's a better sign. So I think that, if we can make further progress during the 90-day pause, that's even better.
You think there was progress today? We just heard Li Qiangang, who's the Vice Commerce Minister, who had those talks with Jameson Greer. He said they had good talks, they had long talks. Does this build on the momentum that they got in Geneva?
Well, I'm not privy to the talks that were held here today, but whatever engagement they have, what we know is that they've set a framework for engagement. So that gives the additional space for them to meet wherever and whenever they can to try and advance. What is good for us is, one, the platform they've set is a good one. It's better than we expected in the beginning. And then the idea that there'll be further progress during the 90 days, I think, is welcome.
How concerned are you, though, through this trade war that the Trump administration has essentially launched, as well as, of course, global tariffs? He's paused it for sure, but how concerned are you that the multilateral approach is being, undermined by a not only unilateral from Donald Trump, but bilateral trade agreements that are being lined up?
Look, I mean, there have always been bilateral FTAs with the WTO alongside. There have been regional trade agreements. So that's not the issue. The issue is consistency with the WTO framework. And that's what we've been urging, that whatever agreements you enter into, that's what I said at the APEC meeting, should be as WTO consistent as you can make it.
I also know, the WTO had an outlook, I believe in April, about merchandise trade going to go into a deficit this year because of the uncertainty. Does the truce, the 90-day, and if it goes on beyond that, does that change your outlook for global growth this year?
It makes it slightly better. The fact that this truce with the 30% tariffs that the U.S. is going to levy on China and the 10% China will levy on the U.S. brings down substantially the number of tariffs so that it makes a difference in our outlook. And it goes from a 0.2% contraction of global goods trade now to a 0.1% growth. But remember, this is still compared to 2.7% growth that we had projected pre-tariffs. So We're not where we would like to be, but we're better with this agreement between USA and China.
WTO Director General Ngozi Okonjo-Iweala there speaking with our Chief North Asia correspondent, Stephen Engel. Take a look at how futures in Europe are opening up for the Friday session of this week. We are seeing sort of a spread of positivity there. Stocks 50 futures up by about 0.25%, some green when it comes to German DAX futures as well. We saw that heavily dominated rally when it comes to defence stocks jumping in the previous session. Attention turning, of course, to a slate of corporate earnings as well. The kind of trade-fueled rally pausing worldwide, but defence companies still really the biggest outperformers. A reignition, if you will, of that sort of rearmament play, with Germany pledging to spend more on its military and defence. We did see that weakness playing out when it comes to oil and energy stocks as well. And given that crude continues to fall in this session, we could see that being extended in the trading session today. More ahead on the Asia trade. This is Bloomberg.
The latest 13F filings are in, and once again, Michael Burry's hedge fund made some of the most interesting moves. Cyan Asset Management loaded up on bearish wagers on Nvidia and China-related stocks in the first quarter. Our tech reporter Annabelle Jewelers joins us now from Taipei. And Belle, of course, this is the person who successfully bet against the U.S. housing market just back in 2008. What are some of the most interesting changes here?
Right, Shery. I mean, when it comes to 13F filings, Scion Asset Management is also always extremely closely tracked. But some very interesting moves that he made in the tech space in particular. So ones to note, yes, as you said, he really loaded up on those bearish bets against Nvidia. I mean, that was quite an opportune time to have done so because it does benefit from declines in the share price. And we certainly saw that in the first quarter because you had the announcement around DeepSeek. You had the sell-off that was related to that because there was this concern that these big AI plays wouldn't need so much compute power moving forward, and so that dented the Nvidia share price. He also loaded up on bets against names like Alibaba, JD, PDD as well. So lots of ones in the Chinese tech space, and these had sort of different fortunes in that first quarter as well. Some having a very impressive run up, Alibaba, for instance, among those. But it is important to note one of the issues or things that's sometimes not clear in these 13F filings. You can have put options, and they could be hedges for investments that otherwise don't show up in the filings as well. So a bit of clarity that we should also give viewers as well.
Let's talk about the Alibaba numbers, right? I think we spoke to our previous analyst who said that maybe expectations were being a little bit set too high there, but certainly in stark contrast to what we saw from Tencent yesterday.
Yeah, there really was a lot of expectation on Alibaba going into these numbers. And as you said, you had those Tencent figures out. They were very impressive, at least at a top-line level as well. And so, yes, there was this sort of hope that you would see good numbers from Alibaba and Tencent, and that would really justify perhaps the next leg of the rally in Chinese tech stocks. That didn't really eventuate quite. We actually did see the earnings coming in very, very close to expectations, but just shy of those. And then you saw that big share price reaction off the back because ADRs, for instance, they dropped nearly 8%. The company, though, is sticking with its plans to invest aggressively in quick commerce. That does remain another headwind, of course, for the company moving forward, just that weakness we continue to see in the Chinese consumer. But still, it is doubling down on its big AI investments as well, and that has been a really key theme for the business, given you've got the likes of the CEO, for instance, Eddie Wu, talking about AGI, artificial general intelligence, still being a primary objective for the business.
Our tech reporter Annabelle Jewelers there. Some of the other corporate headlines that we're tracking this hour: on Coinbase shares slumping over 7% in New York after facing a double whammy of hacking and an SEC probe. The largest U.S. crypto exchange said hackers bribed its foreign employees to steal customer data and demanded a $20 million ransom, which it refused to pay. The breach may cost it as much as $400 million to remedy. Meanwhile, Coinbase has also said that it's cooperating with an SEC probe into whether it misstated user numbers. Meta shares dropped after a report that the company was delaying the rollout of its flagship AI model. The Wall Street Journal reported that Meta engineers are having trouble improving the capabilities of the large language model known as Behemoth. The paper says Behemoth's release has now been postponed to late 2025. President Trump says the Indian government has made an offer to drop all tariffs on US goods. He gave no further details on this while speaking at a business event in Qatar. India's trade minister is expected to meet with Trump administration officials in the US this week for negotiations. Meanwhile, the president also says he's asking Apple to stop moving its iPhone production to India.
I had a little problem with Tim Cook yesterday. I said to him, Tim, you're my friend. I've treated you very good. You're coming in with $500 billion, but now I hear you're building all over India. I don't want you building in India. You can build in India if you want to take care of India. We want you to build here, and they're going to be upping their production in the United States, Apple. So Apple's already in for $500 billion, but they're going to be upping their production.
Shares of Applied Materials fell sharply in extended trading after the company gave a lackluster forecast. The largest American maker of chip manufacturing equipment expects sales of about $7.2 billion for the current period, which is lower than some analyst estimates. The company is adjusting to restrictions on sales to China, which is one of its biggest markets. Bloomberg has learned that the US Justice Department is conducting a criminal antitrust probe into how companies responded to mass concert cancellations at the outset of the pandemic in 2020. Sources tell us that the investigation is focused on whether Live Nation and AEG Presents illegally colluded on refund policies for cancelled concerts. Live Nation has denied any wrongdoing, saying it set its own unique policies and refund terms to support fans and artists. More ahead on the Asia trade, this is Bloomberg. Take a look at some breaking news just crossing the Bloomberg when it comes to Singapore trade numbers. Non-oil domestic exports are coming through at a rise of 12.4% year on year. That is much better than expectations of a gain of 4.3%. Breaking it down, electronics exports rising by 23.5% year on year. And of course, we need to also keep an eye out when it comes to pharmaceuticals as well, which tends to be the more significantly volatile part of this reading, but that 12.4% year on year, much better than expectations of 4.3%. A bit of a relief for Singapore, given just how externally vulnerable this open economy is, particularly when it comes to these ongoing trade uncertainties. Shery.
Heidi, take a look at how Japanese assets are trading. Of course, you mentioned that uncertainty. We are seeing the Japanese yen now strengthen for a fourth consecutive session against the U.S. dollar. We're holding at that 145 level. The Nikkei down 0.4%, and a third session of declines. Of course, earlier today, we saw Japan's economy shrinking for the first time in about a year, contracting 0.7% in the first 3 months of the year on an annualized basis. And this is even before President Trump's blanket tariffs came into effect in April. The contraction due to that drop in exports and the jump in imports. Still, Japan's deal makers are expecting a busier 2025 after over $230 billion in mergers and acquisitions last year. It was underpinned by companies changing attitudes around business expansion. Our next guest says the private equity market in Japan is undergoing a significant transformation. With us now is Takaomi Tomioka, co-head of Carlyle Japan. It's great to have you with us. Thank you so much for coming in.
Thank you very much for having me today.
No, and I just mentioned just the volatility and uncertainty around the trade relationship right now and the tariffs. Does that impact your business, deal making, exits?
Well, first of all, we have more than 10 portfolio companies under management right now, and we are carefully examining impact on those companies. And so far, impact by tariff is quite minimal. And in terms of volatility, that's the issue for public market. We are working in a private capital market, so volatility itself is not really the matter.
Is it an issue when it comes to some IPOs, for example, being postponed, especially when it comes to exits?
That's exactly right. For IPO, this is not easy situation for IPO. The volatility must be eased and settled down in order to make successful IPO. So that's right.
Is it any different in the Japanese market? We heard about a lot of enthusiasm about just deal making in general. Does that help at all?
Well, deal making doesn't change because of current tariffs situation and the possible slowdown of global economy. There are three primary reasons for deal making. One is succession from founder family, and second is carve out of non-core businesses from parent company, and the third is strategic delisting from Tokyo Stock Exchange. Those three reasons are still there, or even enhancing. So quite good situation for deal making.
So when it comes to the $100 billion that you were hoping to spend this year, how far along are you?
Well, we are in the middle of that objective, and actually earlier this year we have closed one company called Kaonabi, software company, through a TOB. And we have 3 to 5 quite feasible deal opportunities in the pipeline. So I'm quite optimistic about achieving 100 billion yen investment goal.
What sort of transactions are we talking about?
Most of them are delisting as well as carve out. We see more and more delisting transactions. As a matter of fact, over the last 2.5 years, 7 consecutive deals are all delisting, strategic private, going private from TSE.
Is that sort of following the global trend of take-private deals, or is it just more specific to Japan?
That's not necessarily a global trend. That's a particular trend in Japan under increasing pressure from shareholders, including activist fund. So that's a unique trend in Japan. And as a matter of fact, I tell you, last year was the first time Japanese publicly listed companies' number has declined. More delisting than IPO. But on the other hand, all other Western countries, US, UK, you name it, number of listed company has been declining by 30 to 50%. But Japan is only country where the listed companies number has been increasing. But last year was a turning point. Declining number of listed companies going forward, meaning more delisting deals.
And a lot of it you attribute to activism. How has really the increased activist investors changed sort of the perception around PE deals?
Well, PE, private equity and activist fund is different. Strategies.
But do they hope to have more understandings and hope to take you on to help them out in a time when they're getting more targeted by these investors?
Well, they become a trigger point of private equity investment. But we are basically working with the management of the target company, not working with the activist fund. So slightly different. But yeah, clearly, since they are putting pressure on the management of the company, and their activity becomes a trigger point of creating private equity investment opportunities. That's true.
Given all of the interest that we're seeing right now in Japan, how has hiring been? I mean, last year when I spoke to your colleague Yamada-san, he was talking about how difficult it is to get actually talent in Japan.
Well, when we enter Japan market and opened the office in Tokyo 25 years ago, by the way, there was only 3 private equity funds. Now we have more than 100 private equity funds, a lot of new entrants. And they are trying to hire good talent in the market. So hiring is becoming very competitive, as a matter of fact. But important thing is track record and reputation in the market. Private equity fund like Carlyle, with the long-time track record, is able to provide a lot of deal opportunities to investment professionals. They like to experience deals. Unless otherwise, they don't want to stay in such a company. So we are in a good position to retain and hire good talent.
Just quickly, Yamada-san last year talked about 300 companies in the pipeline. What's the number now? He told us 100 in each sector, which amounted to 300.
Well, that's a long list. That's a long list. And out of 300, we are, of course, specifying the real feasible deals to shortlist. And I would say our shortlist companies are probably 30 to 40.
Okay, perfect. Takaomi, thank you so much for coming in the Tokyo studio. It was great to have an update. Of course, Carlyle also celebrating 25 years here in Japan. Takaomi Tomioka here. He's a co-head of Japan at Carlyle. This is Bloomberg. Nissan CEO Ivan Espinosa says the car maker must get its own house in order before considering partnerships with other companies. Nissan announced it's closing factories and cutting 20,000 jobs in a bid to stem mounting losses as it posted its worst financial results in 25 years. I spoke to Espinosa at their Yokohama headquarters about whether these measures are enough.
We're confident that this is enough because the plan, as I said, is robust. It has a leg on the fixed costs, which is what you were talking about, restructuring our manufacturing footprint and work around our overall size in terms of human resource. But not only, it has another very strong leg on the variable cost front. Yeah, on the variable cost front, we also have around 250 billion yen of costs that we will reduce. And we are already working on this. We started a few weeks ago with a team of around 300 experts. And in the few weeks that they started to work, we already have visibility to around 75 billion yen of savings in variable costs. Yeah, and we're accelerating this by putting additional 3,000 dedicated people into this sprint on the variable cost front that will drive a lot of savings. Yeah.
Given the uncertainty and the lack of visibility when it comes to tariffs, of course, how will that impact the overall restructuring effort?
Yeah, well, the manufacturing footprint, the design that we put around is very flexible. So one of the beauties of Nissan is that we are a global company that has a very broad footprint in terms of operations. And taking this into account, the plan that we have laid down has this flexibility to adjust.
As you said earlier, the issues are pretty fundamental, right? I mean, given that even without the tariff risks, already Nissan was struggling. How do you turn that around? Even when some people are saying, is Nissan trying to cost cut its way out of finding new innovative models, new products that can appeal to global consumers?
Yeah, but we're not doing that. What we're doing is resetting the size of a company. Even, what we announced was for FY25, if you remove tariffs, the visibility that we have for that company was to be break-even already. So the trend and the trajectory has changed. Tariffs, of course, are a burden in FY25. We have sized the total impact in the year, which is around 450 billion yen. But already for Q1, our visibility is to mitigate around 30% of that. Yeah, and we have teams actively working on mitigating even more. So we think that we will be, I'm not sure if we will close the whole gap, but we will be much better than what we have announced in terms of overall tariff impact.
But when it comes to the manufacturing footprint, Nissan actually shifted manufacturing of some popular SUVs from the US to Japan in the past decade. Given the tariff uncertainty, could you even consider shifting them back?
Now, actually, today, this is a very, very good position that we have. The fact that, for example, our Nissan Rogue today is produced both in the US, in our Smyrna plant, and also here in Japan, in our Kyushu plant. And this gives us this flexibility that I was referring about earlier. We can pivot and change the mix of production depending on the Forex exchange. If the tariffs in some of the trims are hitting us harder because of the supply chain and how the vehicle is composed, we have this flexibility to shift the production, and it's something that is helping us a lot today to deal with the tariffs.
When it comes to car parts, how exposed is Nissan? How exposed is Nissan when it comes to car parts and potential tariff risk?
Yeah, well, as every manufacturer, we are exposed. But the good thing is we have a lot of vehicle lines that are produced in the U.S., and we are working very closely with our suppliers to accelerate more resourcing of parts. But again, I come back to the point of needing clarity, because it's very difficult to invest or to make decisions on investment without clarity on what the rules may be. They're changing every other week, so it's a bit complicated for us.
And you've talked about really these partnerships globally, right? Whether it's in the form of capital discussions or projects. Are full-blown mergers on the table still?
Yeah, well, today we are focusing on our plan, on bringing Nissan back to where it needs to be in terms of sustainability.
But in order to get there, you need help.
Not necessarily. You know, we have very ample liquidity today. We have 2.2 trillion yen in the bank, cash, net cash today. Plus uncommitted credit lines for another much more. We get total liquidity can run up to 3.5 trillion. So we have a solid footing in terms of liquidity today. Now, this doesn't mean we don't need to move and protect free cash flow and protect capex and make some smart choices. But I don't want to become a hostage of our current situation in order to make a decision on partnerships.
When it comes to the capital structure of Nissan right now, and you mentioned how liquidity is still solid, what about investments coming from the likes of Honhai, which have been floated?
Yeah, well, we're open. And as I said, at the moment, we don't need capital investment. We have enough capital in the bank, and we are focusing on building the right footing for the company. So we're focusing 100% on the deployment of the plan, a plan that is credible, that is robust. We have the right people, we have the right content in the plan, we have the right product to support us as well.
Your liabilities will rise to over $5.5 billion by next year. So despite right now where you stand in terms of the capital position of Nissan, you're not necessarily looking at a full-blown merger at this point.
Yeah, we're considering, as I said, the strategy today is to focus on the short-term improvement of the company. Again, the point is not to do a partnership because we need to be partnered with somebody because of the cash position. The cash that we have on hand is enough to go for the next 12, 18 months without doing anything.
So do you have a view if you have a future partnership of what type of company it should be, a car maker, tech company?
As I said, we are looking at different partners. We have traditional OEMs, we have technology companies, and we have also some China. You know, China companies are also very interesting. So we're looking at everything today, but there's nothing concrete I can tell you about that today.
When it comes to sales inside China, for example, your forecast in your latest earnings call was for a fall of 18% or so. Does that mean that you will have to adjust operations, shut down factories if need be?
Yeah, what we're doing today, we have adjusted operationally the capacity in China to run at around 1 million. And we don't see the necessity at the moment to cut more. We are, as announced in the Shanghai Auto Show, we're investing in new cars that, again, as mentioned before, they are going to be focused in China. But the additional leg of this plan is to have exporting these models outside of China. With that, we balance the risk of a very competitive Chinese market, and we bring the strengths that we have today in terms of cost, in terms of speed and innovation and technology outside of China to some selected markets.
What's the time frame of exporting?
As soon as we can.
Oh, within the year?
Yeah, we will do that very quickly.
Nissan CEO Vanessa Espinosa there speaking with Shery in Yokohama. Take a look at how we're tracking when it comes to Asian markets, and certainly the standout at the moment is trading here in Australia ahead of that RBA decision next week, where the verdict is still out as to whether we get that sort of protective cut from the RBA. But at the moment we're seeing Sydney stocks higher for a 7th straight session. This is on track for the longest winning streak since August last year. We're seeing leadership in particular when it comes to some of the miners and metals companies listed on the ASX. Kospi also seeing a bit of upside, but a bit of a reversal when it comes to what we're seeing in Japan there. A third straight session of declines as we saw GDP coming in weaker than expected as well. So, sort of really continuing to cast into doubt the resilience of the economy and the path forward for the BOJ, given the lingering shadows of the fact that the tariff agreement still has not been seen a deal in terms of further progress there. But subscribers can watch us live and see our past interviews with our interactive TV function. That's at TV Go. You can also dive into any of the securities or the Bloomberg functions we talk about. You can join in on the conversation as well by sending us instant messages. Do check it out. It's at TV Go. This is Bloomberg. Alibaba's muted results are set to weigh on Chinese tech stocks in today's session when mainland and Hong Kong markets open in the next hour. Bloomberg's Asia Equities reporter Charlotte Yang joins us now. And so Tencent was an entirely different story yesterday. How do we see the Alibaba downside impact today?
Yeah, so for the broader Hong Kong market, we could be seeing some of those risk-off momentum building up today, after yesterday's consolidation following Alibaba's results. So investors, apparently based on the ADR reactions, which Alibaba filled more than, I think, 7%, investors, what they didn't really like is the cloud growth, even though some analysts think it's still pretty good because it's growing at 18%, but there were some pretty high buy-side expectations that was they were looking at around 20% level. And also investors didn't like the capital spending for the quarter, which was at 24.6 billion, and the expectations was looking at 35 to 40, that type of level. And Alibaba's was also lower than that of Tencent. So even though Alibaba has some of the green shoots in the e-commerce segment, for example, with the customer management revenue growth, but the traders were looking more on the things that disappointed. And if you look at the pricing actions for even for Tencent and JD.com, yesterday the gains, the stocks, the shares fell even after pretty positive results. So I think what this shows is that market attention is now focusing more, on the negative side. And yesterday we also had, the loan data that missed expectations and the total social financing data. So it's looking a bit more on the risk-off side going forward.
And we're also focusing perhaps on some sectors that China's younger Gen Z generation prefers these days when it comes to shopping patterns. How is that going to affect stock investing opportunities?
Yeah, so some of the top winners in the stock market, this year and also last year has been those brands that China's younger generations, the Gen Z, what they like. And analysts call them the emotional consumption. We're talking about the toys like with Pop Mart, or like drinking bubble teas or eating ice creams with Mixue, and also the trendy jewelry brands such as like Laopu, and also like cosmetics like Mao Geping. So the trend is that the younger generations, they like to spend on things that make them feel happy. They stay away from the big ticket items like real estate and property, but they like to spend on these little things that make them feel good. And this is this is a glimmer of hope, I think, for China's economy, but it won't be able to fix the growth model. But on the stock side, it does show that there are pockets opportunities and profit making for investors that have put money in these new consumption companies. And if you're looking at their shares, Pop Mart, among others, have more than doubled over the past year.
Are we talking about Labubu here? Heidi, do you have a Labubu with you?
We have two, but I really do feel like the craze has gotten a little bit out of control now.
I don't get it. They're cute. I think you can get them on a few bags on, but yeah, I have seen them on social media trending.
Are they going to save the Chinese economy, though?
Of according to Charlotte, maybe perhaps the investing markets, perhaps. Great to have you with us. Take a look at how we're trading broadly in the session right now, because we're watching currencies. Of course, the dollar was under a little bit of pressure, but right now we're seeing a little bit of upside on the other side of that trade, with the Japanese yen gaining ground for now a fifth consecutive session. The offshore yuan not doing much, but of course, Heidi will continue to watch those Labubu trades on the Chinese markets.
Take a look at how we're shaping up. If only Labubu could sort of make up for the downside that we're expecting from Alibaba, right, in the broader economic malaise. S&P futures looking pretty flat at the moment. We're expecting to see a little bit of a tick up when it comes to Taiwan futures, but the last traded picture when it comes to A50 China futures also looking a little bit lackluster. The China show is next.